Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
That poll by Bloomberg News and Morning Consult that came out just recently with Donald Trump leading President Biden by only a couple of percentage points. Joining us for some discussion of this is Jodi Schneider, political news director for Bloomberg Television and Radio. How do you see it?
Yeah, I think, a lot of things can be happening at the same time. So while we're all very focused on the debate and the president's poor performance in the debate and what that could mean, there were other things perhaps happening in those states, over that period. He may have visited in those states. So that's the kind of thing that could sway some people. And also the people who might have had a predilection to vote for President Biden, even with the poor performance in the debate, they may have been, pushed even more to that because of Donald Trump's performance in terms of the more than 30 lies he told on the stage, according to some counts of what he said. So I think there's a number of things going on there, but it's certainly interesting. Now, the swing state poll that does show Biden trailing the most in Pennsylvania, down by 7 points, and that's going to be very problematic for him if he can't start making up some of that gap.
Jodi, I'm wondering if these data in any way change some of the private conversation within the Democratic Party. I know that Hakeem Jeffries was speaking with some congressional Democrats today. There are still a lot of folks that want Biden to step aside as the nominee. I mean, this number in and of itself really is not going to do a lot, I would imagine, to change that conversation.
Yeah, so we're seeing more congressional Democrats come forward and publicly say, or certainly in a meeting with Hakeem Jeffries, that they want Joe Biden to step aside. And these so-called defections now include several Democratic leaders of House committees. So that's a signal that even some in the party who in the past have supported Joe Biden want a new person at the top of the ticket. This includes people like Gerald Nadler of New York, Adam Smith of Washington State, Mark Takano of California, according to people familiar with that discussion today.
So in the breakdown of the states there, surprising, as you mentioned, with Pennsylvania trailing by 7 percentage points, but leading in Wisconsin and Michigan, some pretty big states as well. Anything really stand out from these individual states in your mind?
Yeah, so those 3 states you mentioned, of course, are what we call the blue wall states that effectively Joe Biden needs to win to be able to become president. Hillary Clinton lost those 3 states by small margins, but she lost them in 2016. Joe Biden won them in 2020. And there's been a lot of talk about if he doesn't get enough kind of voter enthusiasm, turnout in those states, he could lose them. So it's really key. And Pennsylvania's key. That's where he was born. We saw him go there today, try to kind of rally the troops, and he did meet with him was the sitting senator who's running, Bob Casey, who's running for re-election and has been up in the polls, and John Fetterman, the other senator from that state. So he's getting support there from the party, but that's a place he's really going to need to do well. He spent a lot of time there, and being down 7 points is not a good sign at this stage of the game.
I'm going to go out on a limb here. I mean, if the people that were surveyed as a part of this Morning Consult Bloomberg News poll were aware of Mr. Biden's or President Biden's issues during the debate, we don't see maybe a tremendous amount of movement in the polling. I'm wondering, is there a way to look through Biden in and of himself and to see Kamala Harris as a part of that ticket? Does this in any way reflect mild positivity on Harris at all?
I'm not so sure, and we did kind of ask that directly. I think part of what is probably going on here, and again, to Gregory's point, there could be several things going on here, is that there is a real concern among voters, among Democrats, and Joe Biden has been saying this all along, that he is the best person to beat Donald Trump. There's a lot of thinking in the party still that that's the case. now some of these House members and others who are saying he should be replaced clearly don't think that. But a lot of people do think that. It's very late in the game to be making a change. If it was Kamala Harris, her polling hasn't been very strong. There's some thinking that, she would be a likely successor. She's on the ticket already. She's been vetted, and they would be able to continue the campaign as it were in terms of the money. If it's somebody else, that kind of throws the party into chaos, at least for a period of time. And the thinking is that makes them more vulnerable to perhaps bigger losses against Donald Trump.
Another that you mentioned, just touched on briefly, and Greg talked about as well, is the issue of democracy now rivaling immigration, how that could play into Biden's hands.
Yeah, and there's some in the party, and some very prominent people in the party are saying that President Biden should focus on the issues where Donald Trump is vulnerable. That so much of the talk since a week ago Thursday has been about that debate performance, and that he needs to change the message back to things like reproductive rights, back to what they've done to help the economy.
Yeah. Jodi, thank you for joining us. Jodi Schneider, political news director for Bloomberg TV and Radio. Nancy Davis, founder and portfolio manager of Quadratic Capital Management. Nancy, we like to stir things up a little bit, so true or false? It's evident to everyone except the Fed that the tide has turned on the economy and on jobs. And the Fed is behind the curve now in signaling a cut in rates. True or false?
It's hard to say because obviously the jobs number on Friday, especially the revisions, were much weaker. But the Fed's balance sheet is still ginormous. They really were just kind of only hiking policy rates and not really, the quantitative tightening that we've experienced, especially with the bailout around Silicon Valley Bank March last year, still has kept the supply of money alive and well. So I think, I'm kind of going to go with inflation is definitely priced to fall to 2%. Everyone is very confident that Powell has got this and can start rate cuts, but I don't know if it's the right thing to do yet. TBD.
Why do you say that?
Well, there's so much money out there still with the amount of balance sheet. The quantitative tightening that they did do was really small. They've actually reduced the caps entirely for in the last recent meeting. They're still allowing mortgages to roll off, but it's still tiny compared to the amount of QE that was done. Even the 8 weeks after the start of the COVID pandemic in the U.S., I'm talking March 2020, and that 8 weeks after the start of COVID, remember the Fed came out, Powell cut interest rates all, Sunday evening for the Asian Open. Right in March 2020, and there was more QE done in that 8-week period than there was in the 9 previous years of QE. So the balance sheet is still enormous, and they've really only been kind of tightening policy on one side with policy rates, and the yield curve has been inverted longer than ever in our history of our lifetime. So, the market, there's still a lot of supply of money out there, even though inflation expectations have fallen.
Yeah, and you can also argue that the jobs report wasn't exactly weak. Even though the unemployment rate ticked up to 4.1%, that's a rounding thing. It was 4.054. So really just smack dab in the middle between 4 and 4.1. And then also, if you look at
the private sector was weak. The government numbers looked really strong. But I think, if you put a skeptic hat on, this is the Bureau of Labor Statistics, the revisions from the last jobs report, which looked super hot, were massive. And the private sector is showing weakness. So that's what I mean by weakness.
Where do you see yields going between now and the end of the year?
Well, the yield curve in the U.S. is much more inverted than anywhere else in the world. If you look at, say, Japan's 2-10 swap curve, on your Bloomberg terminal, you can see it's positive 62 basis points right now. The U.S., the 2-10 SOFR curve in dollars is negative 60. So it's literally, same 60 number, but exactly the opposite. And I think that that's really a sign of how much the market does believe that the Fed, is going to be cutting rates because people are buying duration. But there's a lot of expectations that, inflation is a thing of the past. And I'm not convinced, even though it's being priced into markets that way.
We had a little discussion earlier about artificial intelligence and whether or not it's something that is allowing companies to monetize some of the excitement about the theme. We had a downgrade on NVIDIA that was from one researcher, New Street. But then we also had Samsung's very strong earnings on Friday, a 15-fold jump in operating profit. When you look at artificial intelligence and the earnings of some of the top companies, is that enough to kind of outweigh whatever we see from the Fed?
Well, I do think there's been a huge rise really since the financial crisis with systematic strategies. And I feel like the AI models, many of them are momentum based. And so they're just kind of magnifying the theme that we've already had, which is kind of essentially buy what's going up and sell what's going down. And, I don't know, obviously everybody wants a lot of different portfolio styles in your portfolio, but having kind of that group think around, systematic only, and AI is sort of an extension of being systematic. I don't love all kind of the momentum out there because some of the valuations have gotten crazy. And then there's some, pockets of value in the market, but some people are saying that small caps are over, that it's not even an asset class anymore. And inflation expectations are all, right around, if you look at break evens on Bloomberg, on your Bloomberg terminal, you can see they're all right, hugging in the US around 2%. So there are pockets of value, but it's not stuff that's been going up. It's stuff that's been going down.
I just want to be clear, at least in my own mind. I mean, when we're talking about AI, you seem to pick up on the theme of using artificial intelligence in trading strategies. And yes, there has been a lot written about the degree to which AI will impact banking and financial services in a meaningful way. But I think what I heard Brian kind of getting at was this idea that we're going to see such an increase in worker productivity that will necessarily, as a result of the application of AI, that will necessarily make it easier for the Fed to become accommodative. Are we on the same page here? I just want to make sure that I'm understanding where we are in the conversation.
Well, I guess it's all about timing, because if we just play that forward and productivity increases a ton, let's just say that happens, eventually there are going to be a lot less humans that are going to be needed to do the same job, right? The circle comes kind of full force, and then we're going to have a problem with the unemployment rate going higher. So I think we do have to keep in mind that the Fed has dual mandates, and AI might increase productivity in the short term, but it also might mean that people are going to be, look at many countries and regions that have had technology disrupt the labor force and really cause chaos. So it might be good in the short term, but I think long term it could potentially be something that people should be concerned about.
If we could also broaden the conversation to France, because it's the really big story this morning. Money managers had fretted about the right in France. Now they'll be fretting about the left. How should American investors be approaching this?
Well, it's definitely a surprise. I think everybody was really concerned with the right leading, and she actually came in third from what I've seen over the weekend. I think the currency is definitely something to watch. The dollar has been really strong. The yen has been very weak. But it is a surprise to see that's how the voters came out.
Last question before we let you go has to do with politics, geopolitics. We referenced the French election. We've got an election here in the U.S. in a couple of months. I mean, do you have a view? What are the signals that you're getting when you look at market pricing, whether it's the bond market, whether it's the equity market? Is there anything that concerns you as we get closer to the election? Are you getting signals right now that are maybe a little cautionary?
Well, nobody's worried about the election when you just look at the data of the volatility markets. Volatility, especially things like, you would expect rate volatility. When we started 2024, we had over 6 cuts priced in from the Fed this year, and those have been, evaporated over the course of all this strong data in the first, half of the year. So volatility has fallen dramatically. Interest rate vol is down about 30% year to date, which really kind of, doesn't make a ton of sense when you look at the fundamentals and the fiscal situation. And even, there's no election premium. It's pretty complacent. So maybe the news over the weekend with France is sort of, going to remind people that you can't really predict outcomes, and you have to be diversified to be prepared for any sort of scenario, because nobody has a crystal ball.
Shucks. Nancy, thank you so much for joining us. I was hoping that you might have one. Nancy Davis there, founder, portfolio manager at Quadratic Capital Management, joining from Greenwich, Connecticut.
We're joined by Eric Sterner, Chief Investment Officer at Apollon Wealth Management. So interesting time. The jobs report in the U.S. Leaves people questioning a little bit the second side of the Fed mandate. How do you think that Fed Chief Jay Powell will calibrate his arguments in front of Congress this week?
Yeah, well, thanks for having me. And like you said, the Fed's dual mandate to promote maximum employment and stable prices is coming more into balance. Before it was all about inflation and the job market was so hot. Now we're really seeing some cooling here, and even we've heard some Fed talk, well, much Fed talk over the last few weeks, and some officials expressing concern about the softening labor market. I mean, we see the unemployment rate up to 4.1%. It's still a great unemployment rate, but it's the highest it's been since October 2021. And even the JOLTS report showed 1.22 job vacancies for every unemployed person in May, which is the lowest ratio since 2021. So I think there is more of a balance there. And I also think the good news as far as being optimistic of potentially 2 rate cuts for this year is really the lone sticking point in inflation is shelter. And Powell's acknowledged the housing shortage that the U.S. has, and it's going to take years to normalize. So if that's the last sticky component, I think that could pave the way to 2 rate cuts later this year.
Is it possible that the first cut would come as soon as September, in your view?
That's what I believe. I know that there's some chatter that if we get a great CPI report this week, that potentially July's back on the table. I'm not buying that. I think the soonest we can get one is September, and then potentially a second one in December.
So what I was thinking was that maybe we all know that Jay Powell kind of leans a little bit towards the dovish side, but he's had to stay firm, and the Fed has stayed firm. The 550 basis points is there and has been there for a long time. But it seems like that it's turning now, and it seems like this week, if he doesn't show some likeliness to alter the message that rate cuts are coming. And it might be September. We'll still watch the data. Whatever. If he doesn't indicate that, I feel like you could see some selling in the stock market. That people will just say, "Look, the Fed's behind the curve. They missed it on the upside. They're going to miss it on the downside."
Yeah, that's certainly the fear in the markets right now, because we're seeing retail sales cool, consumer spending cool, and I think there is some concerns out there, and that the Fed's going to hold on tighter than it does, and it doesn't have a great track record as far as executing a soft landing. But I think Powell's also kind of trying to learn from some of the mistakes, I call them mistakes in the past, that anytime he's said anything over the last year and a half that's slightly dovish, the markets sometimes could just take off with that and really loosen financial conditions. So I think he's trying to balance that too and hold his cards tight just for that reason. But it will be interesting to hear more comments directly from Powell. I think Powell does want to cut rates in September. The data will tell the story. But clearly, the last few months, even though we had a few unexpected surprises to the upside in inflation in the first quarter, we've seen a lot of cooler inflation reports and cooler labor market reports to go along with it. So I think we are definitely set up for to that first cut coming in September.
So you're a wealth manager, and I'm going to bet that most of your clients are higher net worth. What's the signal that you're getting as we get closer to this election, particularly everything that's been in the news now after that presidential debate?
Yeah, well, what I tend to tell my clients is the stock market performance in election years is right on par with its performance in non-election years. But the one consistent characteristic that election years have is the elevated volatility. And we haven't really seen that in the equity markets. We've seen that in the fixed income markets, but not in the equity markets so far this year. And I think we are going to see increased volatility. I think we're starting to see that now. And even, after that last debate, we saw Treasury yields go up because concerns about the potentially Trump's tax cuts and increased spending. Not that either candidate really has an answer to the growing deficit. But I just remind my clients that it's going to be bumpy, but typically the market will take off after November because then that uncertainty is behind us. So I just tell them to stay disciplined to their plan and try to keep their political views in the voting polls and out of their portfolios.
Even if August is sometimes a rough period. The AI trade has been one of the biggest themes of the year. We've had plenty of days lately where NVIDIA has been selling off because of AI, and Apple and Amazon have been gaining because of AI. So it shows that people are quite unsure here. How do you feel about AI?
Yeah, I mean, it's an incredible story, and it's going to really increase productivity across so many different sectors, and it's carried the market for the last 18 months. And I think it's important to maintain some exposure to those mega techs. But the good news is that I think we're going to see a lot more broadening in the market.
Eric Sterner, Chief Investment Officer at Apollon Wealth Management.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.